What's going on, everybody? Welcome back to the Invest in Wealth channel. Today's video, I'm going to be showing you the importance of investing early and the power of compound interest. So we're going to hop into a compound interest calculator here. I'm going to run through the numbers on what my portfolio is. Then we're going to dive deep into some other stats on why investing early is so important. So for the calculations here, we're going to be using my portfolio balance of roughly $145,000. I am 20 years old, and we're going to say that I will want to retire when I'm 65. So we're going to run through the numbers. We're going to go through a couple different scenarios, and without further ado, let's just hop right in. Jumping on over to the compound interest calculator here, we're going to fill this out. So the initial investment, my portfolio is sitting at $145,000. Regular addition, we're going to say I'm not going to contribute another penny to this portfolio. Interest rate, we're going to take a bit of a conservative 7.5%. Interest will be compounded quarterly because most of my stocks pay dividends out quarterly and I reinvest those. Time horizon in years, we're going to say I want to retire at 65. I am 20 now, so that'll be 45 years to grow. So let's see what this works out to. So when I want to retire, the value of my investment will be 4.1 million. And that's not without putting another dime into my investments. So obviously that's not going to be the case. It's definitely important to invest regularly. As you can see here, total interest earned about just under $4 million there. Monthly table, we'll go to the yearly table. Let's see how much in dividends I will be earning. So at retirement, my yearly interest, so this is the amount in dividends I'd be earning, is just under $300,000 a year, which is insane. This 7.5% that I'm using, why I'm saying dividends earned, is because the dividends I get paid out is about $12,000 per year from this $145,000. So that's where the 7.5% is the dividends I get from my portfolio. So let's change things up now. Let's say my portfolio grows a bit too as well with the dividends there. So we're going to plug in 9%. We'll see how this changes the calculations here. I think 9% is a little more realistic as well. So we'll go calculate and look at this. Just from increasing it to 1.5%, now the value of your investment is almost 8 million after 45 years. And the amount of interest you will be earning a year, $677,000 a year. Could you imagine that? You're definitely have a very lavish retirement for sure. So now let's switch things up here and say, realistically, I'll put in 500 biweekly, let's say. Very realistic for me. This will be even on the low side. So we're going to leave that the same, 500 biweekly. Interest rate, we'll leave the same at 9%. Interest will be compounded quarterly still. Years to grow, 45. So let's see, just by adding $500 bi-weekly, how this changes our calculation. So this changed it dramatically here. So initial investment of $145,000 plus bi-weekly investment of $500 at the annual rate of 9%. The total value of my investment when I'm 65 will be about $15.8 million. Crazy, crazy. This just shows yearly dividends, or yearly interest, I should say, $1.3 million. That is absolutely insane. Now we're going to take a look at why it is so important to start investing while you're young and start investing early. So let's say I'm 20 and I have 10,000 in my portfolio and I contribute $500 bi-weekly and we earn 8%. Interest compounded yearly, time horizon. So I'm 20 years old. I want to retire at 65. So we'll calculate there. Save this number in your head. Say 6 million. So you'll have $6 million when you retire. Now let's say for the later folks in life who don't start investing till they're about 35. So that means you'd have 20 years before you retire. We'll keep the initial investment the same. We'll keep the regular addition the same, 500 bi-weekly. We'll keep the interest rate the same. We're just going to say I'm 35. I want to retire at 65. So that will be 30 years. So it was 6 million. Now, just from the 15 years difference there, look at the value of your investment. In today's day and age, I don't think 1.7 will even be enough for retirement at that time. Just shows you how important it actually is to even invest in your 20s. Even just by waiting till 35, this number has changed dramatically. So let's say you're 35 and you start putting in 1,000 bi-weekly. The other calculation we did with the 20-year-old, this number was 6 million. So we're going to double what we put in every 2 weeks. We'll see if we're going to beat this 20-year-old. Look at this. It's still half. We even doubled $1,000 bi-weekly, and we're not even close to what the 20-year-old will have in the total value at retirement. So now let's say you are 40 years old. You have 10 grand in investments. You're thinking, hey, I want to retire in about 25 years. We'll keep the $1,000 because I'm sure that 40-year-old has a good stable job. So we're gonna keep the $1,000 bi-weekly there. Interest rate stays the same. So just by putting off investments for another 5 years, let's see how this changes our value in the end. So it's almost $1 million difference. You're losing out on $1 million if you hold off investing for another 5 years until you're 40. That is absolutely crazy. I really encourage you guys to play around with this calculator. I'll put the link in the description, but this just shows how important it is to start investing early, have pre-authorized payments come out of your accounts, have that automatically reinvested for you. Because I cannot stress this enough. Investing early, just set yourself up. Your future self will thank you. And just honestly, please take my advice. And if you're not investing right now, please start. Compound interest is a wonderful thing, but really it's like a snowball rolling down the hill. And the earlier you start, the better off you'll be in the end. Hope you guys took something away from this video and learned something. Stay tuned. I'll have more videos out in the future here. I'll see you in the next one. Thank you. Bye.